Welcome to our lecture series on financial institutions. Today, we will talk about the Federal Reserve System of the United States. The Federal Reserve System, often called the Fed, serves as the central bank of the United States. It plays a crucial role in conducting monetary policy, supervising banks, and maintaining financial stability. Before the Fed's establishment, the U.S. financial system faced frequent bank runs, an unstable money supply, and severe credit contractions during crises. The Panic of 1907, where widespread bank runs caused many failures, highlighted the urgent need for a central authority. In response, the Federal Reserve Act was passed in 1913, officially creating the Federal Reserve System. Its unique decentralized structure balances national interests with regional economic conditions. The Fed's structure includes the Board of Governors, with 7 members appointed by the President for staggered 14-year terms. The Board of Governors is responsible for setting reserve requirements, supervising and regulating banks, and overseeing the regional Federal Reserve banks. For example, when the Fed raises reserve requirements, banks must hold more reserves and have less money available to lend. The U.S. is divided into 12 Federal Reserve districts, each with its own regional bank located in Atlanta, Boston, Chicago, Cleveland, Dallas, Kansas City, Minneapolis, New York, Philadelphia, Richmond, San Francisco, and St. Louis. Key roles for these banks include distributing currency, clearing checks and payments, supervising regional banks, and collecting economic data. New York Fed has a special role. It conducts open market operations and implements monetary policy decisions. The Federal Open Market Committee, or FOMC, is the primary monetary policy-making body. It consists of the 7 board members, the New York Fed president, and 4 rotating regional presidents, meeting about 8 times a year to set the federal funds rate. The Fed performs 4 major functions: conducting monetary policy, maintaining financial system stability, supervising and regulating banks, and providing financial services to depository institutions and the government. The Fed uses several monetary policy tools to influence money supply and interest rates. These include open market operations, discount rate, reserve requirements, and interest on reserve balances. One of the Fed's key monetary policy tools is open market operations, involving the buying and selling of government securities to influence the money supply and interest rates. Buying securities increases bank reserves and lending capacity. The discount rate, another tool, is the interest rate charged on loans to banks through its discount window. It is a crucial tool to manage banking system liquidity and influence broader interest rates, encouraging lending by making it cheaper or more expensive. Reserve requirements, yet another tool, dictate the percentage of deposits banks must hold as cash or at the central bank, directly affecting how much they can lend. It influences the money supply, credit availability, interest rates, and overall economic activity, with lower requirements stimulating lending and higher ones restricting it to control inflation. Interest on reserve balances influences banks' willingness to lend, and the federal funds rate is the interest rate at which banks lend reserves to each other overnight. This rate significantly impacts mortgage rates, business investment, and consumer borrowing. The Fed also acts as a lender of last resort during financial crises, providing emergency liquidity to stabilize markets. This was evident during the 2008 financial crisis and the 2020 COVID-19 pandemic. Designed for political independence, the Fed's governors serve long terms, and its operations are self-financing. However, it remains accountable to Congress through regular reports, audits, and testimonies from its chair. Understanding the Federal Reserve's structure, functions, and tools is essential for comprehending its vital role in the U.S. economy and its influence on our daily financial lives. Thank you for watching our lecture video on financial institutions, focusing on the Federal Reserve System of the United States. See you at the next lecture.